Hello and welcome. Our today's topic is cash flow statement. We have already done profit loss account and balance sheet, and we are going to discuss how to prepare cash flow statement. Before I move on to cash flow, I'll just revisit the balance sheet part a little bit. Balance sheet is to be prepared after profit loss account is done usually, but you can always start. But then some of the information such as owner's equity, where reserves and surplus is involved, this information can be prepared only when retained earning information is available. Retained earning is the last data in the profit loss account that you have seen. So, whatever profit remains after payment of dividend is retained earning, that is added to the reserves and surplus of the previous year to get the reserves and surplus of the current year, or as on the last day of the financial year. Before that, it is important to note the source of information in balance sheet, that is the data. Some of the data in the balance sheet are to be obtained from general ledgers like closing stock or inventory ledger. There is a ledger called inventory ledger, which is dynamic ledger in the sense that it starts with an opening balance, and then as you make new purchase of stock, it is added to the inventory, and as you issue inventory for sales, the inventory goes down. So, depending on your purchase and sales, the inventory ledger actually keeps on increasing and decreasing, and as at the end of the year, that is as on 31st March of a year, whatever is the balance, that comes to the balance sheet. So, we can bring the data, or we can get the data on these items from the general ledger. Items such as closing a stock, closing inventory, and then receivable. Receivable ledgers increases when you make new sales. You make sales, suppose you sell for say 1000 rupees, and then payment is yet to come. So, receivable ledger increases by 1000. Suppose later on at any point of time you receive 500 rupees back from the customer, then your receivable is reduced by 500. So, as you make sales, receivable ledger goes up, as you receive payment, receivable ledger goes down. Whatever is the balance as at the end of the year, that is the balance that is mentioned in the balance sheet. So, as on 31st March 2017, whatever was the balance, that is 9,100 that came here, 8,100 is the new balance as on 31st March 2018. So, depending on whatever is the balance, that is just supplanted here, meaning you do not have to do any estimate or anything, you just get the data from the ledgers. Similarly, total trade payable ledgers, it is the reverse of receivables, that is whenever you buy something, suppose you buy raw material of say 500 rupees and you are yet to make the payment. So, trade payable goes up by 500 rupees. Then suppose that on some moment you make payment of say 400 rupees to the customer. So, your trade payable ledger goes down by 400 rupees. So, whenever you make payment, the outstanding balance that is yet to be paid goes down. Whenever you make new purchase and you are yet to make payment, balance goes up accordingly. Short term bank loan is another ledger where whatever is the balance at the end of the year as on 31st March, as on closing of business on 31st March any year, that balance is taken here. One thing should always be remembered is that short term bank loan balance is to be obtained from the bank rather than from the company ledger, because bank keeps on charging some service charges without complete knowledge of the company. These are mutual, based on mutual understanding that bank has this kind of service charges. So, at the end of the year, company goes to the bank and then reconcile company account with the bank, so that there is no conflict in the outstanding balance. Majority of the other entries are based on little bit of estimation, like so for example, equity capital. If the company is the founders are making new contribution, fresh contributions, then equity capital goes up accordingly. say reserves and surplus goes on increasing, or sometimes it decreases depending on if the company is making profit or company is incurring loss. If company is incurring loss, it is deducted, the net loss is deducted from previous year's reserves and surplus or retained earning balance. If they make profit, after payment of dividend, whatever is remaining, they add it to the reserves and surplus, which is also known as retained earning. We will revisit the depreciation part a little bit. As you remember, land is not depreciated, land is never depreciated. If you buy new land, it is just added. If you sell a piece of land at whatever price, whatever is the book value of the land, it is reduced. There will be some capital appreciation, capital gains out of it. We will discuss that later. That is other income, and this has separate treatment. But for building, so you keep constructing new building, maybe you sell some. So whatever is the in previous year account value, then you add any new construction, you subtract construction or purchase, you subtract any sale, and then you get the total value as at the end of the business. Then you apply depreciation. Same is with machinery, but normally it is not really done so straightforward manner. It is done like this. See, building we write as per previous year account, then this is the previous year's account, it comes from the previous year's balance sheet. It is the net value or the book value, whatever is reflected in the previous year's balance sheet. Then you add this year, you write like this, addition during the year. Then if there will be any sales during the year, meaning you sell anything, that is to be deducted, then you get the total value on which you apply depreciation. Now, depreciation on building has been stated to be 5%. So, we use this formula 5% of 1300, which is 65. You deduct 65 from 1300, you get 1235. This is the net value or the book value of the asset. It is not machinery, book value of the building. So, this value goes to the balance sheet. So, let us see there. You see building, here it is 1235 after depreciation. Now, let us see plant and machinery, how this is done. See, as per previous year account is 6800, that came from balance sheet here, that is under that is at row 14, column G. So, 6800 is the previous year's balance, it comes directly here. Then add this year, whatever you have added. So, that fixed asset, there will be a separate fixed asset ledger, sell purchase will be separately mentioned, but in our sum we have mentioned these items separately, and separate, it is always better to mention them separately. In row 12, construction of fresh factory shed is 300. Before that, purchase of equipment in row 5 is 12,000. Construction of factory shed 300. Then purchase of truck is 2,500. Purchase of telephone is 20. Everything together is 14,520. It is better to write them separately. In reality, they have separate estimation for each asset, because each asset class will have a separate kind of depreciation. So, they are mentioned separately. Then you add them together, you get subtotal. Now, if you sell any asset during the year, that is to be deducted. Then you get total fixed asset, which is the sum total. Now, you depreciate this total amount. Here the depreciation rate is 10%. So, depreciation is equal to 0.1, sorry, is equal to 0.1 into total asset. So, it is 1892 and the balance is 17,028, which should come to the balance sheet. machinery is here 17,028. So, that is how it is shown normally. This information is blown up this way, so that there is absolute clarity as to how this depreciation has been estimated. This is also done for a different reason. This is the discussion of today, that is the cash flow statement. For cash flow statement, we would like to know what is the increase and decrease in building and machinery. So, when we talk about cash flow from investment activity, we would like to know how much amount has been invested in creating new building assets and how much we have invested to create new machinery assets. Similarly, how much cash flow we have generated by selling old assets. So, everything together should be reflected at one place, will make estimation very simple. So, when we prepare this, when you blow up this depreciation thing, when you make the total, like say for building account, as per previous account is 1000, add this year is 300, less sold is 0. So, we have total of 1300. So, total of 1300 is, as at the close of the business, is the total asset before depreciation. Then we see what was the book value of the asset in the previous year's closing, at the time of closing. So, at the time of closing it was 1000. So, we deduct 1000 from this 1300 and we get whatever is the addition during the year. Depreciation does not come here, because whatever we procure, we spend money on that. So, if depreciation comes into play, then that is to be added back. So, it will create a lot of complexities. To avoid that, we need to understand whatever is the total value before depreciation. So, let us see about machinery, will be more clear. See, as per previous account, machinery was 6800, which is there in the balance sheet here. Then we purchased 14,520 rupees worth of fixed asset during the year, machinery of 12,000, then 2,500 rupees worth of truck, then there was something for 300, then 20 rupees for telephone, everything together is 14,520. So, subtotal is 21,320. So, this is the balance at the end of the year. Previous year's balance was 6,800, which is right here. So, whatever is the change, that is 14,520, that is the amount of money that we have invested to create new fixed assets. So, that means this is an application of money. So, this is cash outflow. To understand this, we have to do this calculation. Then comes depreciation. We are kind of less. Depreciation should account for whatever we are selling. Whatever we are selling, we want to show in cash flow statement separately. Having said this, now let us move into preparing the cash flow statement. Okay, so first item in cash flow, let us type it so that you remember it well, will be better. We start from here. The cash flow statement, first is I mentioned that there are three sources of cash flow, or cash flow is classified or categorized into three distinct groups based on their origin. One is operating activities, meaning cash flow from operating activities, cash flow from investment activities, mostly they are negative, cash flow from financing activities. Of course, there is no hard and fast rule whether something is negative or positive, but then understanding the rule is very important, which is the point of discussion today. So, we start with cash flow from operating activities. So, let us write from operating activities. So, cash flow from operating activities, we have defined this, the items that are there. First item is net profit. Net profit means before depreciation, because we want to show how much money we are how much money is going from the company as dividend separately, so that anybody who is our audience for the cash flow, they should know how cash is coming and how cash has been utilized That is important. That is the flavor of the cash flow statement. This means that it gives the idea as to how cash came into the company and how cash has gone out from the company. So, we write net profit first. So, net profit, and try to always do it in Excel, and then pick up data from the right place, meaning from operating activities. Net profit is here, retained profit, profit before tax, interest, profit before tax. There should have been profit after tax. I think it's not here. So, there is no tax consideration during this year. We have not taken tax into consideration. So, whatever was the profit, we took it as net profit, and then paid dividend, and came retained earning. Retained earning has been taken as, this is coming from H30. So, H30 is okay. So, it's before dividend cash flow is this one. So, we just add, place it here. So, it comes 12,623 is the amount of net profit. I think we should decrease the screen a little bit, otherwise becoming okay. Cash flow from net profit should come from here, otherwise the value is showing wrong. So, net profit comes first. Next item is meaning adjustment for non-cash expenses like depreciation and amortization. So, in this case, in this sum, we have some amount of depreciation as well as amortization. We have to add them together and then come here. So, let us write depreciation and amortization. So, this should be is equal to, let us put that together to save time. Depreciation is here, total depreciation was this is 65, here it was depreciation total was 1892, total depreciation 1957, plus let us add amortization. Amortization should be somewhere here. Amortization of preliminary preoperative is 200. So, this should be 300, I suppose, whatever that is. So, depreciation amortization is 2157. Depreciation is 19 something and amortization is 200 and something. So, amortization is 200. Okay. Next item in cash flow statement is, now these are adjustment in balance sheet items, like most importantly the increase decrease in current assets and current liabilities, particularly among current asset increase in inventory, increase decrease in inventory, increase decrease in receivables, this is on the asset side, and increase decrease of accounts payable and bank loan. So, these two are important for these four items are to be taken into consideration here. First item, let us see, and one should understand as to how these items are treated. So, let us move this item away, so that we can do the estimation nicely. Okay, let it remain here. So, we need to know whether there is an increase or decrease in these items. Now, you may memorize that as a convention as to when increase of closing stock should be treated as a cash inflow or outflow, or you can understand the philosophy behind it or the logic behind it. That is better, that will permanently remain hard coded in your brain, and you will never make a mistake. Consider closing stock. When closing stock increases, you see that stock is kind of increasing, meaning that you have spent money to create that stock. Take the case of this stationery shop in your hostel that we discussed. Suppose you have, say, just hypothetically, suppose you have 10 pens on your desk to sell. That is your closing stock of pens, 10 pens today. Now, suppose tomorrow at the end of the day you find that closing stock of pens, instead of 10 that was there yesterday, now it is 15. That means that you have the total pens that are there with you has gone up by 5. So, in between there might have been other transaction, like it has gone down, gone up, and then at the end of the day tomorrow you find that total pens are 15, which means that on a net to net basis you have some of your money has gone in to create this extra 5 pens in your inventory. So, you have utilized 5 pens worth of money to create this additional inventory. So, that is why whenever there is an increase in closing stock, this is a cash outflow. You have used money or cash equivalent to create higher inventory. So, inventory going up meaning cash outflow. Similarly, trade payable. Payable means you have sold stock, you are yet to get the money. Suppose the payable was 100. Now, suppose payable was 100 yesterday and today it is 200. That means payable has gone up by 100. Where from this payable come from? This has come from sales, sales have come from manufacturing. So, you have manufactured additional items that you have sold. So, eventually some extra amount of money has gone into producing them or buying the raw material, converting them into finished goods, then making the sales and creating receivable. So, when receivable goes up, that means that money has gone in to create these higher receivables. So, whatever is the difference, whatever is the additional amount that has gone in to create the higher receivables. Now, the reverse also is true, like if the receivable goes down, suppose yesterday the receivable was 100, today the receivable is 50, which means that you have recovered some of the receivables and converted that into money, meaning that some customers who purchased goods from you and then he was yet to make payment, that is why receivables were 100, today made some payment, maybe say 60 rupees. So, now 40 rupees remains outstanding. So, this whatever amount it is reduced by, that amount of payment has been made by him. So, there is a cash inflow. So, this is the philosophy. In whatever transaction money is realized, cash goes up. So, there is a cash inflow, money goes down, then that is a cash outflow. So, let us now move into the cash flow statement. So, after depreciation, let me write the main items, then we will pick up from there. So, let me type it here. First item is cash or increase. Let us write increase in inventory or stock, whatever call them. Then we will write increase and then it will come with their sign, increase in say receivables. receivables, then increase in payable, then increase in bank short term bank loan. This is very important. So, there are 4 items mainly, but there may be others, like there are prepaid expenses, then small items may be there where which are represented in balance sheet and their balances goes up or down. So, depending on that, those are also to be included, but let us remain as simple as possible. So, increase in inventory, if there is an increase in so we need to understand how much is the increase decrease in inventory. So, before we start preparing cash flow statement, it is better to make this difference. So, here closing inventory, you just you write difference at the top, and then whatever is the difference, say cash in bank, this should come from cash flow statement itself. So, we are not discussing about that. Closing stock, so this is equal to this minus this is the increase or decrease. Similarly, this should be is equal to this minus this. So, we do not have to make a subtotal, but for every amount we have to really make whether we are increasing or decreasing. Here also land also you can always make whether there is an increase or decrease, then you can make the formula. So, here it is this minus this is equal to this minus this. So, we have all the changes here. This will be easy for us to make. Now, increase in inventory, if inventory increases, we said there is a cash outflow. So, if it is cash outflow, then we can always write if there is an increase, it should be deducted. So, we write is equal to, we write with a minus sign here, so that will nullify if there is an increase or decrease depending on that, and then we pick up the data. So, it becomes minus 1200. There is an increase of inventory. So, that means minus 1200 of cash outflow. Similarly, increase in receivable is the same thing. So, we write is equal to and put a negative sign here and then pick up the data. So, it will automatically nullify if there is a negative. So, receivable actually went down, that means that there is a cash positive inflow, cash inflow. So, is positively reflected. Increase in payable, increasing, if there is an increase in payable, it is actually cash inflow, because you are getting some goods without making payment. So, it is money equivalent. So, if there is an increase in payable, that means you have received goods without making payment. So, it is almost like money has come in. That is why this is just straight equal to, we do not have to put a sign there. Pick up the data. So, we got 957. Increase or decrease in short term loan, we will discuss about short term and long term loan separately, otherwise it will be too involving. So, increasing short term loan, we will just, if there is an increase in loan, if there is an increase in loan, then money is coming in, and if there is an increase in short term loan should come in investment activity. So, let us not write it here, we have just these amount, increase in payables, receivable, payable, depreciation, amortization, 4 items. So, let us make the subtotal. I am sorry. See, as I mentioned, cash flow from in financial activity includes financing activities, include loan from banks and equity contribution to equity. So, obviously, this should have been, there should be no ambiguity on that. So, total is 14,537, this negative has been taken care of. Now, let us estimate cash flow from investment activity. cash flow from investment activities are means it arises from making new purchases of building, new purchases of plant machinery, and if you make any new investment, these three items. So, land purchase, land building, any fixed asset purchase, and then if you make a small amount of investment. So, it is not three, but there may be many. You can buy land also. So, let us see, we have not purchased any land. So, there is no cash flow from land. So, from building there may be cash flow, we saw there is something, and we have to pick up data from this place, what we have estimated. So, the difference of building is 300. So, we have to pick up this data from 300. So, let us go back there. So, building is equal to whatever is the new addition or subtraction, that is here is 300. So, it is added there. Cash flow for machinery purchase, not sell, is equal to, we are going to show sales separately, so that the information is meaningful. Total is 14,520. Total means the difference between previous year's closing balance and this year's, not closing balance, but this year's total. So, this is 14,520. So, we can either, okay, let us put it there. So, we could very well write it as a single item also, like single item, meaning that from building machinery we could have written as single item. Then if there is any investment activity or say sale of machinery, sale of machine or building or anything is equal to, we already have this data at different places, we can pick up from here itself, from the data that was supplied to a sale of old machine is 2,400. This is cash inflow, because this money is coming in. So, total is subtotal is okay. We should actually consider this building, total building that we are acquiring is negative, because addition of building is happening. That means, we have invested money to acquire the building. So, we should put a negative sign there. We should put a negative sign there. Similarly, here, because we have created new machinery, so we need to put a negative sign. For sale of machinery, cash flow is positive, so we do not have to put anything, and subtotal is here is minus 12,420. Now, let us make cash flow from financing activity. Financing is cash flow from new long term loan, that means long term bank borrowing, then short term, you can put a dash actually here, short term bank borrowing, then there may be fresh equity investment, equity subscription, let us call. So, one by one let us pick up the data. Long term bank borrowing comes from previous year account and whatever repayment you make. You should not take it from the bank, because there might be some interest that is yet to be paid. So, this information should definitely come from your ledger, whatever was the balance in the previous year, and if you have made any repayment towards principal amount, that is to be deducted from there, and the balance should come here. So, let us see is equal to, let us pick up the previous year's data from the balance sheet. So, it should come in the liability side. So, long term bank loan, long term loan was 5,600 minus, we know that there was some repayment of bank loan. So, that is to be repayment of bank loan here, this amount is equal to whatever is the amount, that is the amount of that is the balance of bank loan, but bank loan has gone up by I am sorry, this should be the amount that has been repaid only, or if you make new loan. See, we have repaid 1600 rupees worth of bank loan, that is repayment of bank loan is 1600. We have just paid that. So, this is a negative cash flow, it should come with a negative sign. If we have raised new loan, then we should estimate, if we make a new bank loan, suppose we raised 3000 rupees worth of new bank loan during the year, then we have to pick up data from the balance sheet, that is previous year's bank loan was 4000 rupees, or previous year bank loan for term loan is not relevant in this case. What is relevant is the new bank loan plus minus if you have made any repayment. What I was discussing, that is about short term bank loan. Short term bank loan is to be picked up from the balance sheet. So, this should be is equal to whatever was the balance in the previous years. So, here in the liability side, you see whatever is the short term bank loan, here it is short term, long term loan. Short term bank loan was 9430, that is the balance. Then there are some, no, there is no interest payment. It has to be as I said at the beginning only, this is to be taken from the ledger, short term bank loan ledger. So, we have to simply pick up data from here and enter. Now, no, again it is the closing balance. So, we have to see the difference between the previous year's balance and this year's balance. Previous year's balance was 9430 minus the current year's balance is 4928. So, whatever was the balance at the beginning of the year, that is the balance in the closing of the year previous year. So, that minus the closing balance this year makes the increase or decrease in the loan account. Now, if there is any decrease in the loan account, that is cash outflow. If there is an increase in the loan account, that is cash inflow, meaning that if there is an increase, that means we have received some money from the bank. If there is a decrease in the balance, that means we have repaid some of the amount, even though in short term bank loan account there is no concept of prepayment, but balance has gone down, that means money has been used to bring the balance down. So, this should be, because it is a repayment, so this should be a negative cash flow. So, let us put a negative sign there. And fresh equity subscription, we know that the founders have made some fresh equity subscription. Let us see how much that is. Founders contribute new equity is 500. So, that is a cash inflow. This is cash out. Long term bank borrowing goes down by 1600 rupees. So, we have used some money, and then short term bank borrowing goes down. So, this is also utilization of money. Then equity investment. So, new money comes in. So, that is positive. Let us make a sum total of this, which is minus 5602. So, one is operating cash flow from operating statement. Operating activities are 14,000. This is cash flow from investment activity, from financing activity. So, total cash flow or net cash flow is equal to this one plus investment activity plus finance operating activity. So, total is 3,485. 3,485. Therefore, okay. So, now notice that there is a negative cash flow, which happens when company invest more than they make profit. Suppose they make a profit of say 20,000 rupees, but during the year they make more investment in plant and machinery, or their inventory goes up, or receivable goes up, or their payable goes down, meaning that they make payment, too much of payment to the suppliers. So, they utilize more money during the year than they make, meaning compared to cash flow, cash inflow, they make more cash outflow. Then there is a cash mismatch, meaning that they gradually goes down on the cash part, and then when cash flow, total cash position becomes negative, then it becomes untenable. You cannot really place a negative cash in the balance sheet. Now, let us see, to the total cash flow you have to add back the previous year's cash. So, previous year's cash was 1940. So, whatever is the previous year, so add previous year's cash, year's closing cash. So, this is equal to 1940. So, you are now net cash as at the close is equal to the previous year's cash plus this year's cash generation. It is negative generation, this remains as a negative amount. So, our current year's cash balance should be picked up from here, is equal to, in the balance sheet, is equal to this one. So, that comes as a negative value, which is unlikely, and we will revisit that later. So, that makes the total of asset side as 41,018, and the liability side also is 41,018. So, though balance sheet balances, but we cannot really write a negative cash balance here. That means the company actually is moving towards a very precarious situation. So, they had to actually arrange cash in between. So, they could not actually afford to bring down the outstanding balance position in the short term bank account. So, this is an hypothetical case. So, company really have to bring more money to make this cash position positive. Suppose we consider that the outstanding balance in the short term bank loan account is let us not consider that it has gone down significantly. So, outstanding, suppose we modify this data which has been mentioned as 4,928. Suppose this is say 8,000, it is not so less. If we put 8,000 rupees here, then everything changes actually. Then your cash position will be positive, because now previous year's cash balance was 1990 and short term borrowing has gone down only by 1430. So, total becomes only minus 2530, and in the process total cash flow becomes only negative 413. It is kind of tenable still. So, net cash close balance is 1527. So, the cash position comes here as 1527, and the total of the asset side become 44,090, and the liability side also becomes 44,090, because it is all from formula. So, depending on how you change your balances in the ledgers, like I have changed the balance in outstanding short term loan to 8,000. So, cash position becomes slightly manageable. So, this gives a kind of a clear picture about the cash flow statements, how they are prepared and what are the considerations. So, we will revisit in a nutshell in another class, so that we connect all the three statements together in a single kind of a snapshot to give you a bird's eye view all over again. This much is today. Thank you very much.